Meet Your Trading Experts live and free. Our first morning episode ever. I'm coming to you live from managed isolation in the hotel in Singapore. It's great to have your company. Appreciate you joining in, enjoying your commute to work this morning. We're on a 2-minute countdown before we start our interview with Gordon Scott. Gordon's the latest addition to the Actions 12 trading team, and he'll be leading us into stocks and options and talking about that in a couple of minutes. If you have any questions, you're welcome to put in the questions box while I'm here. I've got a couple of minutes beforehand where I can say hi and do anything that you'd like us to do. As I say, I really do appreciate the effort to come in while we're having morning commutes, etc. I can see a few of the names in the attendee list, and not all of you are doing morning commutes right now by the look of that. I can see we've got Gary in from Australia, and a couple of the sort of full-time traders are in with us as well. Good to have your company in. And hey John, welcome along. Nice to have you in, mate. Good to have your company for today. Looking forward to the trading retreat next week with you guys. You know, a chance to really spend a bit more time working through some stuff together. Can see Alexis, one of the members of ATW trading teams, popped in as well. Good morning, sir, and welcome along. Nice to have you here, buddy. Good to have you guys in the room, and nice to have your company. As you guys know, this will be streaming to Facebook and YouTube and Twitter, and some people will watch recording of that a bit later on, or may watch the live stream of that as we go along. So again, welcome. Good to have you guys on. We'll be starting in 40 odd seconds, as you can see, with the countdown counter, and we'll be getting straight into asking Gordon some questions. Feel free, if you have any questions during the session, to put them in the question box, and if we have time at the end, I'll see if I can get those questions to Gordon. We are always conscious of time. I'm going to try and keep this to around 30 minutes today. I'm just going to see if I can pop my phone up so I can see my questions a little bit easier in the background. It doesn't seem to want to play that game today. There we go, that'll do. Rightio, so we are about 14 seconds away from starting, and I will grab the screen and we will get on with this, guys. Hi everybody, and welcome along to Meet Your Trading Experts for today, the 20th of January 2021. It's our first session for the new year. It's great to be back and to have you guys back. And I think more interestingly, we're doing our first ever morning session. Our 7 p.m. Thursday slot is gone, and we're back for just this session at 8 a.m. on a Wednesday morning. And we're in at this time of the morning because my guest today is in America. He's a stocks and options trader, Gordon Scott. Gordon, welcome to the show. Oh, Gordon, you are muted. We need to get you unmuted. We had you unmuted. There we go, mate.
That work?
Yeah, that is perfect. How are you going?
Good. Thanks very much, Paul. I'm happy to be here.
Mate, good to have your company. Look, the people in the room will know that as a bit of background, the Actions 12 trading team in general, we're able to add one Forex trader a year to our team, and that's the target. A couple of years ago, it was Ainsley, who you know. We've been very fortunate. We've had Lincoln join us at the end of last year. We've been very fortunate to bring in some, really classy people. And the addition of Leon Ho, a chief analyst for a European bank and on a ECB monetary advisory committee, continues to bring in Forex traders of some ability for us. And the big challenge for me for some years has been finding somebody else. We've had Shukri come in and do cryptocurrency, and our guys will know. Shukri's been on. One thing I love about Shukri, yesterday he told people that it was time to start selling Bitcoin, and he's a guy that has that kind of ability to say, actually, I've just made an absolute killing and it's time to get out. And he's brought some real options to us, but I've been looking for someone to do stocks and options for us for a long time. And in all honesty, Gordon, until we were put in touch, I just haven't found anybody who has the partnership we're looking for. People who work with us have got to be knowledgeable. They've got to want to help other people. They've got to have personalities that we like. At the end of the day, we're likely to spend a week in Bali with you at the end of the year, and we want you to be somebody who we're looking forward to spending some time with as well. So welcome along. I'm thrilled to have you on board. It brings to the end about a 4 to 5 year hunt for the right person to make this move. We haven't rushed it. We're not a rush it company. We're a take our time. So very much welcome. And team, again, if you have any questions, feel free to throw them in the questions box and I will answer them for you. And Gordon, I've got a few questions for you.
Sure.
So we're bringing you in as a trading expert. And so I guess the first thing is, how long have you been trading and what have you been trading?
I'm glad you asked. I hope I can make it short. I've been trading for about 20 years actively trading. And before that, I was an employee at IBM. That's kind of where I got started trading, actually. I had a 401k account, and the only interesting thing in that account was IBM stock itself. So I found that if I moved all of my money into IBM stock and all of it out, that I could get a lot better performance impact on my than just putting it in some collection of mutual funds. I didn't really know what I was doing, other than internally I thought, well, the company's probably getting a little undervalued by the market. I see stuff that's going on here, so I'll put it in and hold on for a while. And that really worked for a good 5 or 6 years. And I ended up doubling my retirement account over that period of time, independent of my contributions. And so I felt like that was better than any of the mutual fund performance that I could have had.
Yep.
And then when I left IBM, I had a moment where I was joining a small company, and they were they were in the business of doing software for internet companies. And the year was 2000, so the timing was exceptional. It was actually exceptional for changing one's career. And I found myself in the dot bomb era at a situation where I thought, wow, I really need to just kind of do my career over. What am I going to do? And I thought, this time I'm going to do something I feel so passionate about that if I, blew up doing it, I would still want to keep doing it, and I had studied instructional technology, how to, teach people online. And that was back in the 1990s, when it was very rare to do that. But then I decided to shift into trading, learning about trading stock and options. And so it took me a couple of years of very intense, uh, self-study. And I was very fortunate during that period of time to come across professional market makers and proprietary traders. I actually joined a proprietary trading firm at that time. And so I learned really fast, and I learned a lot in a very short period of time from people who knew an unusual degree about the markets. And so that was kind of my foundation.
Gordon, it takes real courage, right? It took real courage 20 years ago. It takes real courage now. Stepping into this as a career, it takes real courage. It's not something where, when you tell people, I'm going to give up my job and do this, all your friends don't say, that sounds really cool. Everyone says, wow. So it does take real courage. It did take real courage, and it still does. And so for you, about 2 years from really getting into it to starting to step through to feeling you were becoming comfortable and profitable.
Well, what I noticed happened was that I had a tendency to overtrade. And when I was just trading myself,
Yeah.
I would, make 200 trades a day, that sort of thing. And it was just eating up commissions. Nowadays, commissions and commission structures and places that you can go to trade are far more favorable than they were in the early 2000s. But I was still making money despite that, but I realized I needed something to sort of dampen my my tendency to want to trade and be high frequency without being algorithmic. And what I realized I like to do is teach people about things. I mean, that's why I got into the business of instructional technology to begin with. So I thought, what I really need is a line of work where I can teach someone and I can be trading, and kind of do those both at the same time. Because if I'm talking to somebody, that'll keep me away from the buy button all day.
Yep.
And if I'm talking about trading, that'll keep me close to the markets and keep me understanding what's going on. And so I began coaching in 2004 and teaching people one-on-one. And after a while, people became aware that I both knew how to coach others and I knew how to write instructional online programs. So I also had a second line of work, and that was to consult companies and individuals on how to create curriculums for teaching people how to learn stocks and options. And over the years, I've kept refining those to the point where just in the last year, the last time around, a good friend asked me to come and collaborate with him on teaching people in a way that would really be qualitatively better than anything out there. And And we found it. We found something that showed performance. That is to say, we took people that were just average, ordinary, everyday people, and we ran them through a 8-week period of one-on-one, once a week coaching kind of environment, and it was stunning the results that these people were able to get. One gentleman, I'll share a little of his detail. He was an extremely knowledgeable individual, MIT doctorate and Berkeley professor. So he was smart by every measure. And yet for over 10 years, he hadn't been able to trade profitably at all. And so he came along and was part of the program. And I started teaching him a few things. By the end of the first session, he said, "Gordon, I'm so excited. I've never heard any of this before. I'm so excited. I'm shaking right now." That was lots of fun. But what was even more fun was getting a call from him in the depth of the pandemic last year to hear that he was trading profitably on the system that we had set up for him some months previous, and that he was very satisfied. So not only was he trading profitably for the first time, but he was doing it under extremely adverse conditions. So there are a lot of stories like that, and I'm really thrilled to have the opportunity to work with Actions to Wealth to be able to bring this kind of curriculum setup and start teaching some of the things we've recognized actually do help people learn to trade better.
So for you, you're a trader, and your skill is about creating educational pathways that are more effective than the average ones. So you can teach people in a more efficient way, basically, which means with less time and potentially less investment from them, and get them a better result at the end of them. That's your professional skill.
That's correct. Yeah, I am part of the Chartered Market Technicians Association, and one of the guys that for a little while I was actually the managing director of their exam program, and one of the guys that would come and speak at our symposiums was a gentleman by the name of Thomas DeMark. He talks about how back in the 70s he was tasked by Merrill Lynch to find every possible trading and learning methodology that was out there. And he had a blank check to fly the globe and go and do whatever he needed to do. He tallied up that he spent over a 5-year period, $15 million of Merrill Lynch's money teaching himself how to trade. And my goal would definitely be to beat that. 5 years and $15 million is far too much for anybody to pay.
Yeah, mate. Look, that's awesome. Look, one of the questions I was going to ask you later on was, what's your best achievement as an educator? Is that your best achievement as an educator? The ability to quantify this stuff down to this stuff works, and I can teach it in a way where people get it and make money from it more quickly.
Yeah, I feel like it is. I feel like the of all the things that I've helped people learn and been part of in terms of both curriculum development, whether I'm generating the content or I'm curating somebody else's content. I've had a lot of fun at Investopedia, helping them set up all of their courses, and TD Ameritrade. I was head of content there for a while, and I worked with Van Tharp International and Beacon Learning and Trade for Life Institute, and these people, all great friends of mine. They have good instructional systems. The last time I got to teach, I only took 15 students through this program. And because I don't like spending 40 hours a day as a job. It's like I want to bring somebody in, I want to teach the amount I want to teach, I want to trade the amount I want to trade, and I'm at a point in my life where I can do that, and I can kind of pick and choose the things that I get involved with. So I was pretty excited here to have an outlet for what I do consider my greatest instructional achievement, and that is creating a system of a course and then a system of instruction to follow onto it that I believe can more effectively bring people into trading profitably than anything else I've done. I feel like just within a 2 to 3 hour period of time, somebody can know the basics, but then I have a list of exercises that people can use to self-study and self-improve. I mean, that's what I did. It took me 2 years to really get to the point where I was on top of things. I feel like with the exercises and the information that I have collected together, someone can do it inside of 4 months.
That's pretty amazing. And look, I'm going to ask you the tough question, Gordon, because the truth is that no educator can make everybody profitable. But you think that with your system, you're going to have a high percentage of people, if they do what's asked of them, and look, this is the same thing. It takes two hands to clap, right? You've got to teach. They've got to work, right? It's not. This isn't a magic wand that makes them millionaires. This is a skill they learn and they train. But you're expecting your percentage of people who are profitable to come from this program to be well above market norm, right?
Yeah. I mean, so that's definitely true, because market normal is 4% or less, right? There was a study, very extensive study of day traders in Taiwan. They took 10,000 or more accounts of people who were, signing up to trade stocks in Taiwanese brokerage accounts. And they found that something like 4% of those people would wash out in about 2.5, 3 months. And so most people look at that study and they use that study to say, see, there it is, 96% failure rate for trading. And I suppose that's true if you really don't know what you're doing and you jump in. And under that standard, then I got very lucky, because that's what I did. I jumped in and didn't know what I was doing. But I did do a couple of things right. One, I played for the long haul. That is to say, I got in it with the idea that I was going to still be doing it 2 or 3 years out. And I didn't want to do anything that would mess it up for me along that way. And what the study also shows is that if you, as a trader, manage to be around, not blow out your account, that is to say more than 50% loss in a whole year, in a 1 year period of time, then your success rate goes from 4% to 40%. That's a 10 times increase in your ability to become a profitable trader, or in your probability of becoming a profitability trader, just because you hung around for 1 year. Well, I'm not ever going to have enough, large scale study, but my belief is that the people that work through the curriculum that I have will probably achieve that level of probability within just 4 months period of time, rather than a whole year.
Nice, mate. Really cool. Look, I do need to check because I don't think we've asked you yet. What products do you trade? So we're bringing you in to do some different stuff. That's why I understand you do trade Forex, but it's not the majority of it. What are the products that you trade?
So over the past couple of decades, I have traded Forex, futures, commodities, gold, silver, the indexes, ES, NQ, TF, that sort of thing. But what I trade nowadays is U.S. stocks and the short-term options that go with it. And there's a big reason for that. Ever since about a little more than a year ago, when all of the U.S. brokerages decided that they couldn't allow Robinhood to steal any more of their commissions, they all cut their commission to zero, and that is just an incredible benefit to the active stocks trader. And in the 10 years leading up to that decision, the ETF industry has just exploded with all sorts of fabulous tools for the short-term trader, all the double, triple, and inverse funds that you can trade. Now you have the ability to trade those instruments friction-free. You can just make very short-term trades and pay no commissions for them. Meanwhile, although options still have commissions, options almost always had the base commission plus the number of contracts. Well, that base commission's been wiped away. So now if you're trading the right options, you have, again, a far more advantageous opportunity to reduce the slippage, reduce the transactional cost that comes with it. And if you understand how to work with the leverage that comes with options, a lot of people they're all about the leverage. And of course, that's very dangerous. But if you have a systemic approach to it, to where your upside is potentially large, but your downside is limited, then any kind of trading, whether it's futures, Forex, or stocks and options, and particularly in the stocks world, that's true as you get lower and lower priced in the stocks that you trade. There's a limit. There begins to be certain amount of risk when you get down below $1 a share. But if you're in that area between $1 and $5 per share, or even $1 and $10 per share, you have a special equity class that allows you to expect much greater upside percentage-wise than downside. And you have to have a systemic approach to it. There's no guarantee in any of the things you trade. But I find that if you trade those instruments, then your opportunity to have a higher expectancy, a higher expectation of returns over many trades is greater, and it gives you better probabilities as a trader. And so now is probably the best time that I've ever seen in my trading career to become an active trader and to start learning it, and have a hope of a hope of high profitability.
So Gordon, options allow you to trade in a way which can provide you higher returns, and trading in the right price value of the stock also allows you to do that. Are you able to give an indication of the kind of returns that doing this can make conservatively? Please don't push it out. Just don't do that. Don't tell me that you make 500% the first week. Just a general realistic,
So academics like to say that there's this thing called the efficient market hypothesis. And what the efficient market hypothesis tells you is that you can't predict anything.
Yeah.
So if I were to sit here and say, I can tell you which stock is going up tomorrow, I can tell you how you're going to make 100% return next year, any of those predictions, of course, would have no factual basis.
Yeah.
What I do is I start from the position that, all right, let's assume these academics really have it right. And I mean, there are actually some very serious problems with the efficient market hypothesis, but let's just assume they got that right.
Yeah.
And let's assume that the markets are random and I don't have the expectation to be able to make any money at all. The first question I have to answer is, why then does the Dow Jones Industrial Average and the S&P 500 index, both of which have a near 100-year history of data associated with them, why do they, when you look at the chart, do they start in the lower left and go to the upper right? And there's very little fluctuation, right? That's a really improbable outcome for a random market. So what's the answer? Well, the answer is that probability works in a certain way. And what I find is that if I can teach somebody how to work with random probabilities and then show them how to track properly risk versus return ratios, then I can actually show them how they can figure out what their own expectation for profits would be. And I try to tell people, if you can't get yourself to 20 to 30% returns over the next 100 trades, then you shouldn't start trading. And so we work in paper trading until they can achieve. Everybody does better in paper trading than real trading. But if in paper trading you can start there, then you can actually start trading. And I find that once they become proficient at that, those aren't unrealistic numbers. And then it's just a matter of how frequently do you want to trade? How frequently can you guarantee the quality of your decisions and so forth? So being able to make 20 to 30% out of 100 trades, if you make 100 trades in a year, think of that, right? That's about 10 trades a month, about 2 to 3 trades a week. It's not really high impact kind of trading if you're a trader. And then being able to translate that into 100% returns. I had one student that actually did exactly that. He started off making about 16% a year, so he was doing well. But when he came with me, I showed him where he was kind of having some slippage, where he was leaking, so to speak, and from his performance. And he brought that up little by little to 20 and then 30 and 35% by the time we were done. 6 months later, I had contact with him, and he had his system tweaked into such a high degree of efficiency that he was on track to make 100% a year. And in fact, over the course of that year, that is what he made. I don't usually have the good fortune of being able to keep up with all my students that way. Yeah. However, 20 and 30% annual are, I don't want to say everybody gets that every year, but I mean, there's a high number of students that I've talked to that have achieved that level.
Because one of the things that really fascinates me, Gordon, is that, you're trading stuff that when you look at a chart, always starts at the bottom on the left and goes up to the right. And that's what inflation-based assets do, right? That's what indices do, stocks do, gold does, silver does. These kind of things over time all do that. Whereas we trade Forex. And what that does because it's a product versus product where inflation doesn't play a part, over a long period of time, it spends a lot of, really it's a range. All Forex is in a massive range. And coming along and trading things that are in a massive trend, if you've got the skills to be able to make money in a massive range, put yourself in a massive trend, you're going to go pretty well. And I'm really looking forward to seeing our guys. And we're going to be talking more on the retreat. I'll be talking in the retreat a lot about the difference between trading Forex and other products like this. Is there one or two key differences? What's the difference between, say, Forex and stock as far as trading it?
Well, I'm glad you really mentioned that because I've been doing some research in preparation for this class. And one particular thing I'm doing is something I like to call semi-seasonal research. Seasonal research, the idea that throughout different times of the year, there are different things that you can expect to have happen. Well, the research that I started in the book that I co-authored about, I guess it's been 8 years now, was the idea that if a certain event triggers conditions in a market, then how does the seasonality of the market work from that event? So it's, it can start at any time, but then 12 to 14 months afterwards. Well, so I compared stocks and Forex, and it's just as you said, stocks have this nice trend up after that event, whereas Forex pairs have this sort of wave pattern that goes for 12 to 18 months after the event. And I realized that's a big function of the fact that you've got Forex prices being comparative from one currency to another. Almost every government in the world wants to slowly and carefully devalue their currency so that they can pay off their debts easier through an inflated currency value and that sort of thing. So, but when you take two of them and compare them to each other, then they have relative fluctuation, and you don't get the sort of propping up that happens from central bank interventions all around the world. And that stuff ends up in the stock market, which is why so many people feel like they need to participate in stock markets to keep ahead of their own local inflation.
Let me ask you, Gordon, you're welcome to give the book a bit of a push. What's the name of the book?
It's called Invest to Win. It's $20, $10 if you buy it Kindle on Amazon. It's co-authored with Tony Turner, and she was really great to work with because she, like myself, is a self-taught trader who she got divorced and out of that needed to find some way to support herself. And of all the things she chose trading. And she joined up a New York firm with a New York firm and in Manhattan, cut her teeth trading for the first couple of years, and then went out on her own and began to trade and write books about it. And still to this day, she lives in Florida. She's very personally successful trader, like 50-60% a year she's capable of doing. And it's she's very quiet about it. She doesn't go around making a lot of noise, but she knows what she's doing, and she just writes very simple concepts. So she asked me, I approached her about the idea of co-authoring a book, and she said, well, Gordon, if you do this, you can't bring all of your, big brain stuff to it. You got to keep it real simple. So that was my challenge, was creating information that was going to be tailored and easy enough for her audience to absorb. But there was something that we worked on together, and she let me pioneer it and champion it and bring it out in the book that I was so proud of. And that's this, semi-seasonal stuff. It's what I called the 56-week pattern. And it's just been such a useful technique for trading stocks. And you can't use this particular technique in Forex, at least not until now. I've found a way to sort of bridge the gap. But one of the things that I have, going back to your question about differences between the Forex and the stocks market, the stock market is filled with a lot of institutional investors that have well-defined goals. They aren't to beat the market, right? Some of them, sure, but not all of them. Most of them are to beat whatever benchmark they have so that they can earn their big paycheck and keep their job for next year. And it's that might mean that in a year when the S&P 500 is up 13% if they're up an 11.5%, they're golden, you know? So they don't always have the ability to have every investor's best interest at heart. They just hope that their own needs are close enough. Well, if you understand what their goals are and what they're looking at, then you can look at the stock market and make some decisions that that give you an edge. Whereas in the Forex market, those things aren't those things aren't so apparent. I find that the Forex markets are a good bit more challenging. The upside is that because the Forex market has a truly greater degree of randomness to it, that you aren't consigned to failure. You really can make excellent returns so long as you're doing good risk management and that you are handling your position size strategies well. Position size strategies are practically everything in Forex. In the US stock market, position sizing and risk management are critical, but actually what you trade, picking the right stock, picking the right class of stocks, picking the right group of stocks at the right time is almost as critical. It has almost as big an impact on your returns, just being in the right place at the right time. You can make a whole lot of mistakes if you're trading a stock like Amazon for the course of 10 or 15 years.
Got to ask you a couple of questions. Was the book Invest to Win?
Invest to Win. Let me see if I can type it in the chat there.
That should be in there for you.
There it is.
Yeah. I want to see if I can quantify this just into other language for the people listening, right? And I'll see if I've got this right. What we're saying is that seasonality exists, and in normal circumstances, seasonality is seasonality, and it does what it does. But what you're saying is sometimes an event turns up, and that impacts seasonality for a foreseeable period of time, where you can say, actually, Brexit, that there might be a seasonality in the pound, but Brexit turns up, and all of a sudden that seasonality is not relevant because the data in the future and the data from the past are no longer the same. And what we're going to see is we're going to see this event impact for 56 weeks as a suggestion, and that there's going to be some predictability about that move we can take from the earlier parts of the move.
Yeah. So that's an excellent synopsis. What got me started on this was the flash crash in the US in 2010. There's a lot of people that ran around trying to find explanations for it. And in the end, most people just sort of pointed at high frequency trading and computers did it and so forth. And I've never believed for a second that that was an appropriate response to why the market did what they did then. Or, I mean, maybe in 1987 when computers were genuinely new. But I mean, I worked at TD Ameritrade and had a very good look at their order flow, and I saw what their computers were capable of in 2007, 2008, and 2009 when things were just crazy, and their computers were handling it just fine. The idea that somehow we would go through all of that and then in 2010, oops, bug in the machine, that never sat right with me. And so I went looking for reasons to explain what exactly had happened. And what I realized, I talked to several professional money managers, and they all had an algorithm that was just unspoken. It was like breathing to them. It was so obvious. Everybody surely does this. And then I talked to professors at business schools across the US, several different business school professors, and they all said the same thing, that what they taught, what they believed in when they go into industry, what their students acted on, was this notion that when you buy something in the stock world, you should hold it for 1 year, because after 1 year, then you could pay long-term capital gains taxes, which were half or better of what regular taxes would be. So there was very strong incentive from their point of view to hold things longer than 365 days. They literally had rules that would say, I'm going to buy it, and I've got no stop loss, and I've got no sell rule for 366 days. After that, then I'll start making decisions, and then here are the rules I use. That was so prevalent. Obviously, not everybody does that, but so many people were doing that. I began to think of a hypothesis that could it be that there was something that made a whole bunch of people all decide to sell out on the same day. I was driving to and from an office in a high traffic area, and I was sitting there in a traffic jam, and I realized the only reason I'm having this experience right now is because everybody wants to go home at the same time. In the middle of the day, there's not a traffic jam on the freeway. And so it's a function of everybody trying to do the same thing at the same time. And I thought, could it be that the markets are that way as well? And so I looked back and I realized that if you take March 9th as the low of the market in the S&P 500, March 9th of 2009, after the big financial crisis, everybody had just unexpectedly bad returns and worst performance in a century, right? And then all of a sudden, within a year, those markets are up 65% from their lows. 65%. Everybody would be crazy not to take something off of the table, some amount of profits from that. And in the professional money management world, that's exactly what they were all thinking. And so if you take 1 month and add it to March 9th, you come up with April 9th. And that turns out to be just a little bit in front of when the flash crash begins. There's about 6 days where the market kind of looks weak, and then all of a sudden, kaboom, it just collapses. And at that particular time, we realized, I realized that this was probably more likely done with large amounts of orders walking onto the then physical floor. It turned out, there was one broker, Waddell and Reed, that literally walked 12,000, if you can imagine it, 12,000 contracts of the S&P 500 for sale immediately. It's like, wow, what are you thinking? What do you think that's going to do to the price of the S&P, the whole market in general, right? Why would they do that? They're not some high frequency, smart, super. Waddell and Reed at the time was not known for their super deep 4D chess strategies. They did whatever their customers told them to do. Well, their customers wanted to take a little money off the table, and it just happened that a whole bunch of them wanted to take it off all at the same time. And it sent the market down in a spectacular fashion. And I realized, okay, if I'm right about this, then we're going to see this happen again about 56 weeks later in 2011, and again about 56 weeks later in 2012. So 2012, that day turned out to be right after the 2012 election, Mitt Romney and Barack Obama. And I was doing a webinar, I was telling everybody, right after the election is done, the markets are going to go down. I don't know how much they'll go down, but they will go down. They'll go down for about 4 weeks, and it won't matter who wins. And people say, are you sure? If so-and-so wins, won't it be worse? Well, like, nope, it won't make a bit of difference. They will go down. But once they go down, somewhere between 4 and 8 weeks, they'll make a turn. And in that turn, you want to jump in. And I had no idea how right I was at the time, but following that methodology, I was able to recognize a really good buy point. 2013 turned out to be this fantastic year, just straight up, but it was because collections of people were all doing the same thing at the same time, and you could kind of predict, well, then that will necessitate they've got to do something else at some point later on, and that's the basis of it. I've dug down and got a good bit more sophisticated since then, and I just can't wait to share the research.
Look, I love that. And at the end of the day, Gordon, sophisticated doesn't matter, right? If you've got the right, it's about getting the basics right. I love this thing about, markets are about the crowd, and understanding what the crowd's likely to do gives you a huge edge. What I want to do is I want to ask you one quick question, look for a reasonably quick answer from you. Then we're going to talk about the 3 programs that are coming up. And then I've got people who I know are on trains, driving to work. We're about 20 minutes away from work starting here. So I'd like to do the next 5 or 10 minutes. We'll do the question. We'll talk about the products. We'll give people who do want to join in. Look, people should be getting an idea of the kind of value we're talking about here. So anyone that wants to join can come and get one of those early spots. And then we might just hang out for a couple of minutes and answer any questions. But what I do want to do is make sure the people who are about to jump off buses, trains, get out of cars, that we do get the strap up a little bit for them. What's the one thing you wish you'd learned earlier in trading?
The one thing that I really would have liked to have learned early on was how to control my risk with options. I spent a good couple of years trying to figure out how to, I traded well in stocks. I'd make a lot of money in stocks and then I'd give it all back in options. And that went on for about 2 years until I kind of began to understand what really matters the most in options trading. And managing that time decay of options is the important thing. And really, it's just another layer of risk management. Risk management is the most important thing across all trading. And If I'd have learned about the options market earlier, then I mean the right way to do risk management in the options market, then could have had a lot more fun.
And we're going to teach our guys about option trading on February 21, right? You're going to do 3 programs for us, right, Gordon? 3 one-day programs, Jan 31, Feb 21, and March 13. And the one on February 21 is about options. Let's go through them though. 31st of January, it's a Sunday. The topic's called banking on randomness. Why? What's that mean?
Well, if we take the premise that markets are random, and then we still find that there's a way to trade them profitably, then we can always trade them. We could trade them no matter what the circumstances are. We could trade them regardless of the outlook and the whatever instruments we're using. Now, the instruments might contribute to our edge, but if we are trying to say, I can trade profitably only when certain things happen in the market, or only if, then that means literally trading is a seasonal operation. But if in fact we accept the idea that markets are random, and yet there's still some way for us to trade them profitably, then we can trade them whenever we like. And I believe that is true. I believe that my research has proven that out. And so the first day is the first program that we're offering there is, how do you think about the markets as if random walk theory, somebody mentioned, is true, as if the efficient markets hypothesis is true, and how can we expect mathematically to make profits? Well, there's an easy explanation, and the answer is randomness trends. Even random data has trends. The book Fooled by Randomness, talks a lot about how people look at random patterns, randomized data patterns, and or randomized data, and they see patterns in them. They're like, oh, that wasn't really random. There's no pattern in them. Well, that author actually missed an incredible truth. Randomness has patterns, and I'll be showing why that's true and what those patterns are, and then how you can use that in your own trading.
Look, Gordon, for people who are listening to this and thinking, wow, that all sounds like a lot and it's quite complicated, does your day work the same? Do we start with quite a lot of information, and as we go through the day, it gets simpler and clearer to the point we get an outcome which they can use to make money?
Yes, absolutely. I mean, you don't have to. I'm not going to be presenting, deep math that you wouldn't understand unless you took a master's degree in it or something. Now, this is very simple ideas, and they lay the foundation for how to think about the markets. But in terms of what you actually do, very simple, straightforward stuff, very easy to follow signals, and it actually puts less and less emphasis on the timing of your entry and more on the management of your position after you've made an entry. A lot of people really want to, like, what's the right stock, the right price, when to get in, and so forth. Turns out that's only about 10% of the success of your equation. The bigger decision is, how do you get out? And so if you understand how to get out, then getting in, flip a coin.
I really love that, Gordon, because I think that the truth is that for most traders, finding an entry is almost something they're driven to, and they find it quite easy. But should I take some profit? Should I let it run? Should I half and half? That stuff not only is difficult for traders, but it gets in their heads, and more importantly, it gets in their heart. Emotionally, it hurts them. They look back on every single decision and try and work out whether they got every single decision right. And part of this is that you're not going to get every single decision, or are they? They're not going to. You don't get every single decision right.
No, in fact, the system that I'll be teaching makes it so you don't have to worry about getting it right. What you need to get right is that you have a single decision that you make systemically for the next 10, 15, 20, 30, preferably trades. And I'm going to show people how they can choose the win percentage that they want. Most people assume that, gosh, if I'm winning 60% of the time, then I'm making money. Then I have a successful system. I'll show you how to have an 87% system, the system that the MIT and Berkeley guy trades with, or how you can have a 30% system. A student I have in Belgium who trades that way. Both of them equally profitable, but they chose what fits their personality. They chose what helps them consistently make good decisions. And it's not the same for everybody. Everybody can choose different things, but they can literally choose, this is what I want my average win percentage to be. And then therefore, once they choose that, they can know what kind of outcomes they're going to get over time. They can look at a projected equity curve and say, I'm going to have this kind of experience. And when I get down to this low part right here, everybody's going to have a losing streak.
Yeah.
Then I should be in this range. If I'm still in that range, no problem. Just keep going. If I'm not in that range, put my trading on pause and let's figure out where I've got a leak.
So we're going to simplify this down to simple decisions and the ability to track that in a way where they'll understand whether it's working or not working. Look, I need to get on to February 21, and that's called leveraging your edge. What's leveraging your edge about?
So when you determine that you have an edge, and we assume the markets are random, and then we look at a few things that somehow persist in the markets that give you an edge. And we're going to suggest that these, half a dozen things that are persistent out there, research shows they're persistent, are things that traders can pick and choose from and use, incorporate into their own trading system. Once you have that, how do you take leverage and make more money with it? So this will actually help me answer a question that was posed in the chat. In stock trading, which kind of trader, short, medium, or long term, is more profitable? And the answer is whichever one of those trading timeframes helps you to most consistently trade excellently. It turns out that there isn't a time frame that shows performance over another, collectively. But there are time frames that this trader A is no good here, but is really good there, and trader B vice versa, right? So it's the time frame that really works for you and with you most effectively in order to do it right. How do you figure out what that is? Well, that is absolutely what my information is about. Now, once you figure that out, then you ask, how can I do better? How can I make more money? And you look for leverage instruments that make sense for you. In the US, that's most frequently options, but it could also be low price stocks. In other countries, it could be CFDs. I don't have a lot of experience with CFDs, but I have coached people who do and who have them. And the similarities between options and CFDs are extreme. They're very, very similar.
Am I right, Gordon, that so we teach people that there are, if you like, a number of things that can give you I think you call them things that, despite randomness, occur consistently in the market, and you can track them. And we say that these things occur regularly in the market and you can use them, but you're going to show them that these things occur regularly in the market, and here's some data to back that up. You're going to put a little bit of stuff in behind without
yes.
a billion spreadsheets and lots of math. You're going to say, well, actually, we've tracked this and this works.
Yeah. I have a lot of my own research, but I also will draw on research of others that has been published and is publicly available and persists today. The idea there is that these edges are, anytime you hear an edge, this is the thing. I worked with over 24 different people who had their own trading system, and they wanted to sell it to other people because they said, hey, this trading system is the best. This indicator is the holy grail. It's so good. And I developed my own little 4 or 5 question survey for them. I said, look, you got to answer these questions in order for me to even give you the time of day on your system. Because if it doesn't fit within this framework, it's not likely to persist. And so the very beginning of the Banking on Randomness will show people how to tell whether a trading edge is likely to be a persistent edge, because it fits with the way random data acts. And so that's what we look for, is not just any edge, but edges that are consistent with the way random data behaves.
Brilliant. Look, the last program for now is March 13th, low cost growth stocks. You've talked about those. Why are we doing low cost growth stocks?
So within the stock market world, low cost growth stocks, that is both a company whose price is low, but has something about it which has the potential for growth, right? Any stock that's priced low is priced for failure. The market assumes it is about to go bankrupt. And there's a good reason for that. I mean, 99.9, that's a literal statistic of those stocks do go under. And so you think systemically playing in that region is like, playing
Sounds awful.
baseball or cricket in
Yep.
the streets. You know, it's
Yep.
just like you wouldn't do it.
Yep.
But if in fact you understand what the difference between a busy street is and a abandoned back alley, you can make the activity significantly safer. What we do is we look at the things that make low cost stocks actually have better potential for growth, to truly be growth companies, because as it turns out, those companies have the best growth potential in the market of any stocks out there. It's probably the most consistent way to beat the large cap liquid stock market.
Mate, we're going to answer some questions a little bit later on. I know our crypto guy Shukri is asking a few questions in here. We will get back. We'll get back to them. Look, I want to talk about the 3 programs. First of all, at the end of the show today, we're going to do a draw, and somebody in the show today is going to get the chance to win one of these courses. And if they've joined all of them or paid for all of them, we'll refund them on that one. But if you get involved, someone in the room will get to win one of them. What we are going to do, and look, we've said to you that what we want to do with this is we want to make it as widely available as we possibly can. We want to base it on our database, and they can bring friends on that in. And what we're going to do for these programs, full day with Gordon. You guys have heard this, right? I'm sure if you're listening to this, you're thinking, wow, $147 for a day or $397 for the 3 days is what we're going to do for that. And if you want to join that, click on the link that Angel's about to post into the chat and jump in and be one of the first people to register for this. Now, obviously, if you're going to do a 3, you've got to get registered so we can get you in for the 31st of January. If you click on the page, look, I do like to share these pages just because I think sometimes things that we see ourselves look really simple to us, and for people seeing stuff for the first time, it doesn't always look quite so simple. So if you click on the link, it'll bring up this page here. Now you can choose banking on randomness, you can choose leveraging your edge, you can choose low-cost growth stocks, or you can do the 3 for $397. Now again, banking on randomness is the 31st of January for the day. Now Gordon comes in from the US. My recollection, Gordon, is we're going to start a little bit later in the day soon and go a little bit. I think we're talking about maybe 12 to 8, that kind of time sync from memory, just to make sure we fit into the day for you reasonably well. Maybe we're going to start with earlier. Leveraging your edge is the 21st of February, and low-cost growth stocks is the 13th of March. You can do any one of them for 147 Sing dollars, or you can do the whole lot for $397. And if you want to share this with your close friends, people in your circle, you can do that. Please don't sell it on Facebook or anything like that. But if you've got some people who you know are interested in this kind of stuff, it's our first major step into stocks and options, and we are very much looking forward to getting there. Now, look, for those that need to get to work, click on the link, get your spot, get into work. If you have any questions for the rest of them, if you post the questions, I'll run through those questions with Gordon for a couple of minutes here, and then we will do the prize draw. I am aware we're getting close to the start of work for some people. Now, gosh, Zoom does this to me where it's hidden the chat box. I don't love it when it hides the chat box. Roy, any lucky draw today? Yes, there is. There's a lucky draw coming.
Yeah, well, that's a good question. Are we? Oh, no, sorry. You're talking about the draw for the class, right?
Yes. Sorry, mate. Can you answer the question from Shukri about the Chinese Telsa?
Sure. The NIO stock, it's really an interesting situation. I was working with a student that I was teaching. I had not been watching the Chinese electric vehicle stocks, and he brought them to my attention, and he had jumped in with an option. I had been telling him to practice. He actually went in with real money, and he got very, very lucky, and he caught a rise on that, and it went up, and he got out. I told him, I said, look, you got to take your money. This is really cool. Yeah, you've more than doubled your money. You made over $2,000 or something, and I said, here, you gotta get out, and I know it might go to the moon after that, but you got to get out because you need to know more about what you're doing. So he did, and it kept going up very strongly for the next 2 days, and of course he was chewing his teeth about that, but then it came back down far worse, much lower than where he got out. And I said, the problem is you just don't know. You don't know where that's going to go to. And if you don't have a plan, then what you do is you try to stay in there going as long as you can until all of a sudden it runs against you, and then you're stuck deer in the headlights and you don't know what to do. So have the plan, proactively get in, get out. To answer the question, NIO, would the system that I teach about low cost stocks have put people in NIO? And the answer is that it probably wouldn't have put them in during the period of time that everybody has been watching here, just this past October and November, because it was already fairly high by then. However, it could have put them in earlier, in August or November, or sorry, August or September. And the question is one of whether or not you would have a system that would allow you to stay in the trade long enough. Those stocks have tremendous amounts of fluctuations, and low cost stocks, you've got to determine, a good risk management system. So the answer to that question, I'm sorry, is not as clear cut as it's a maybe, and depends on you whether or not you would have gotten a big trade like that.
So Gordon will be coming into the trading retreat and talking to us. He'll be opening the US Open session for us Monday to Thursday next week for those in the trading retreat. So we'll get a bit more time to see him work through this stuff. For those of you that want to, I like that, Shruti, thanks. I've got time for one more question before we do the draw. If there's one more question and it goes in the box quickly, I will take it. Otherwise, we will wind her up and let you guys get to work. I know you've got some bosses that want to see you guys this morning. Really, hopefully they won't need to see you in a year or two if we can keep working hard on progressing your trading along. Look, it's $147 sing for one course. It's $397 for the three. Clearly, we've priced it up to try and make the three as attractive as we possibly can. And honestly, I think if you've listened to Gordon for 45 minutes, you understand that is ridiculously good value. And this is a program which can be taught to you in a way where your chance of learning it and progressing from it is faster than normal. And you're talking about a man with 20 years experience working for a number of the big names in the industry. So jump in and get that. I've had no questions jump in. So what I'm going to do is I'm going to do a lucky draw. Here's the lucky draw rules. You've got to be in the room to click the prize. You'll be able to pick which course you want. And if you've already paid for it, I'm going to refund you for it. Okay. So Angel, can you do a lucky draw for us? Here we go. Remember, guys, you've got to be in the room to get the lucky draw. We're spinning it away. Who's going to be our winner? Here we go. Don't know why my name's not now. Wouldn't mind winning it. M.E. Wong. I think that's probably Michael. Michael, M.E. Wong, are you in the room? If you are, please post in the chat. Say you're here. We need to hear from you in the next 30 seconds. There you go. I am. Which course would you like? To know which one you'd like, would you like banking on randomness on the 31st of January, February 21 for leveraging your edge, or March 13th for low-cost growth stocks? The options one, the second one, that is cool. We will give that to you. And if you do choose to do the three, we will refund you half for the one that you're supposed to have won. Congratulations, you're our first one in as we move into stocks and options. Gordon, the truth is I have to bring it to an end because otherwise I could sit here and do this all day long. But it's fascinating to hear you talk, and I really enjoyed it. Thank you very much for your time. And we really look forward to working with you in the next period of time and to bringing this stuff to our people. I look forward to talking to you again. I'll see you next week in the trading retreat. I know you're going to be speaking in the trading retreat about correlations between FX and stocks. Very much looking forward to hearing that program as well.
Yes, looking forward to it myself. Thank you very much, Paul.
Each of the courses is one day, guys, and I can't remember, Gordon, are we doing it from 12 till 8?
I don't remember the timing seeing. I know that I'm planning on 8 hours of content and all one day. It's going to be drinking from a fire hose, but you're going to be satisfied and happy when you're done.
Fantastic. Look, and I can't remember whether we decided to start a little bit earlier to fit on the end of the US evening, or we decided to give you a break and start at early morning US, but we'll get those times out to you in the next couple of days. Do just email contact actions to Wealth if you need anything on that. Once again, to all of you attending, thank you very much. Enjoy your day as best you can. I hope if you're going to work, it goes okay. I hope if you're trading, look, guys, just make good decisions and it all works out. We'll see you soon, Gordon. Thank you very much. And to the attendees, thanks very much for joining us. If you're watching the recording, sorry you can't do the draw, but I hope you've loved the information.